Okay, so let's talk about ARM. We're looking at a company with a valuation north of $143 billion. And right now, it's making one of the biggest, boldest bets in the entire history of tech. It's this massive, high-stakes pivot that has Wall Street completely split down the middle. And it all really boils down to one single question.
Right? Is this the company that's going to power the next generation of AI? Or is this just a stock that's gotten so hyped up, it's priced for a future that might not even happen? On one side, you've got this incredible, visionary strategy. On the other, a valuation so high it seems to defy gravity. And to really get a sense of just how high we're talking, you have to see the number that's at the heart of this entire debate. Get this. ARM's price-to-earnings ratio is hovering around $185. What does that even mean? It means for every single dollar of profit ARM makes right now, investors are willing to pay $185. To put that in perspective, that kind of number makes even the frothiest, most high-flying tech stocks look kind of cheap. It's wild, and it's at the absolute core of why this company is so controversial.
So how on earth does a company get a valuation like that? Well, to understand that 185x multiple, you first have to understand the truly historic gamble the company is making. I mean, they are fundamentally changing the business they've been in for more than 30 years.
For decades, ARM was basically the Switzerland of semiconductors. It was a beautiful model. They didn't actually make chips, they just designed the blueprints, the intellectual property, and then they licensed it out to everybody. We're talking Apple, Nvidia, you name it. It was a fantastic, high-margin, low-stress business. But now they're jumping into the ring themselves. With their new model, ARM is designing and selling its own physical chips, and that means they are no longer Switzerland. They are now a direct competitor to their biggest, most powerful partners.
So why on earth would you make a move that risky? Why mess with a great thing? Well, that brings us to the bull case. This is the rocket fuel that has sent ARM's valuation into the stratosphere. People who are betting big on ARM see three really powerful reasons this could all pay off spectacularly.
The whole bullish argument really rests on these three key pillars. First, unlocking a massive new market. Second, absolutely dominating the next wave of AI. And third, a powerful, almost secret weapon they have in their parent company, SoftBank. Okay, let's start with the market. Under the old model, ARM was just getting pennies on the dollar in royalties for these chips that would sell for hundreds of bucks. But by selling their own silicon, they're not just taking a slice of the pie anymore, they're going after the whole thing. They are now targeting the massive $100 billion plus data center market, and management is aiming for $15 billion in chip revenue alone by 2031. It's just a complete game changer for their potential.
And check this out. They're not just strolling into this market with some run-of-the-mill chip. Their new AGI CPU is specifically designed for what's called agentic AI. Now think of it this way. Not a chatbot that just sits there waiting for you to type a question, but an AI that's running constantly, doing its own autonomous tasks in the background. That kind of work requires incredible power efficiency and density, and that's where ARM's new chip just shines. It's a 3-nanometer design with 136 cores. It offers more than double the performance per rack compared to older chips, and it could potentially save a single data center $10 billion in capital costs. That's a number that gets attention.
And now for that third pillar, the secret weapon. What does this number, $500 billion, have to do with ARM? Well, pretty much everything. This is the price tag for a single, gigantic AI data center project being built in Piketon, Ohio. And the entity leading the project? ARM's parent company, SoftBank. I mean, just let that sink in for a second. SoftBank is funding what's being called the largest single infrastructure project in human history. And because they own 87% of ARM, you can bet they're going to make sure this massive new data center becomes a huge, captive customer for ARM's new chips. It's like having a guaranteed demand pipeline that no competitor can even dream of.
Okay, that all sounds absolutely incredible, right? Almost too good to be true. And that's where we need a little reality check. It's time to talk about the bear case, which argues that the hype has gotten way, way ahead of itself and that there are some serious risks hiding in plain sight. Starting with that valuation.
Yeah, the heart of the bear case comes right back to that price tag. Let's use a key metric called EV to EBITDA. Now, don't worry about the jargon, just look at the numbers. ARM trades at a multiple of around 131. Now compare that to Nvidia, the undisputed king of AI hardware, which trades at 38, or AMD at 59. You see the disconnect? ARM is valued at a level that is orders of magnitude higher than its most successful peers. It's in a completely different universe.
As one analysis I read put it, the stock is just priced for absolute perfection. And that's the key. What that means is the current valuation leaves zero, and I mean zero room for error. Any stumble, any delay, any unexpected competition could have a really devastating impact on that stock price.
And the first big risk is exactly what we talked about before. ARM is now going head-to-head with the very companies that made it a powerhouse. Amazon, Google, Microsoft, even NVIDIA. They all use ARM's blueprints for their own custom data center chips. By launching its own CPU, ARM is basically attacking its own customer base, which could easily push them to look for alternatives, like the open-source architecture known as RISC-V.
But then there's another risk, and this one is pretty surprising. It's something most investors aren't really talking about yet: the Helium Shock. And yeah, it sounds like a plot twist in a movie, but trust me, this is a very real threat.
So here's the breakdown. The conflict in Iran has shut down natural gas operations in nearby Qatar. The result? About a third of the entire world's helium supply has just vanished. Now you're probably thinking, helium for balloons? Nope. Turns out helium is absolutely essential for the advanced 3-nanometer manufacturing process that ARM's partner TSMC uses to build that fancy AGI CPU. There's no substitute for it. So this one geopolitical event thousands of miles away could cause severe production delays and cost increases, directly threatening ARM's ability to deliver on all its huge promises.
So where does that leave us? We've got a visionary bull case on one side, set against a crazy expensive valuation, and some very, very real risks on the other. How do you put it all together? What's the final verdict?
The core tension here is just crystal clear. On one side, you have this absolutely brilliant strategic pivot into the AI market, with what looks like a superior product, and it's all backed up by its massive parent company. But on the other side, you've got an extreme valuation that's basically priced for a flawless victory, all while facing these severe supply chain and partnership risks.
And that tension leads to the final rating in the analysis: neutral or hold. The conclusion is basically that the business strategy is visionary, but the stock price has already baked in like a decade of perfect execution. So given the risks, the recommendation is to hold on to any shares you have, but maybe don't put new money to work until that price comes back down to earth or those big risks get resolved.
So in the end, it all comes back to this. There's really no doubt that ARM is building a critical piece of the AI future. The real question, the $143 billion question, is what's the right price to pay for a piece of that future today?